After the Second World War and 4 years of draconian martial law, the marshy island known as Hong Kong was starving, miserable and destitute. To turn its fortunes around, Britain selected a Scottish economist, John James Cowperthwaite. He disembarked in 1945 and was assigned to the Department of Supplies, Trade and Industry, pursuing policies that promoted free trade, low taxation, budget surpluses, free market policies, and fiscal discipline. Given his innate distrust of central planning and his affinity for sound money, Cowperthwaite preferred to rely on experience, empirical data, and pragmatism, rather than reverting to dogmatic economic theory. Hong Kong's tax policies were, in fact, the mirror opposite of those pursued by mainland Britain over the same period. Instead of high levels of taxation, government spending, deficit spending, centralized industrial planning, and economic intervention, in the colony of Hong Kong, all but the richest paid no income tax at all. Even higher earners only paid an average of 15% tax. There were no tariffs or duties, there was no sales taxes or VAT, no taxes on capital gains or on overseas earnings, although there was a land value tax. The overall tax burden never exceeded 14% of the colony's GDP. During his spell as financial secretary from 1961 to 1971, real wages in Hong Kong rose by 50% and the percentage of the population living in acute poverty fell from 50 to 15. By 1993, Hong Kong's GDP per capita exceeded that of the United Kingdom, and by 2010 it had overtaken that of the United States. Today, Hong Kong ranks among the 10 richest city-states in the world with a per capita GDP 40% higher than that of the United Kingdom and, despite its low tax regime, the former colony offers superior schools, healthcare and the best public transport system in the world. So where does this miracle leave us when it comes to arguments over progressive taxation? Well, first and foremost, parking money offshore is not free. It is expensive for both tax avoiders and governments alike due to the high fees levied by bankers, accountants, and lawyers. So individuals and corporations must have good reason to hide their money on sunny islands. When governments overspend, for instance when a fiscal stimulus proves to be a damp squib, or when they are forced to bail out banks and corporations following lockdowns or stock market crashes, they seek fast capital through taxation as a way out. However, higher corporation taxes simply encourage the creation of sham company registrations in tax havens like Ireland, Luxembourg, or the Cayman Islands, while higher business rates either drive shops out of business, online, or offshore. Super tax, as applied in the United Kingdom in the 1970s, at a time when top band tax rates hit 90%, simply triggered an exodus of capital and capitalists. So what are the constructive alternatives? First, dropping corporation taxes to 10% would be effective, as higher taxes disincentivize entrepreneurial activity and drive capital and entrepreneurship away. After all, what would be the point in paying high parking fees offshore when tax rates in the place of business are so low? This would be likely to increase the overall tax take. Second, a luxury goods tax on all non-essential purposes including fine dining, second homes, luxury cars, yachts, private planes, and a levy on vacant properties, would be far more effective than direct taxation on income, especially if adopted widely. Third, reducing income taxes to a 20% flat rate would discourage avoidance and make it effectively cheaper and more convenient to pay onshore taxes than to pay lawyers, accountants, and havens to park it offshore. Fourth, a 10% internet sales tax applied to all online purchases, to offset tax avoidance through registering an origin of business in a tax haven, which would be levied instead of corporation tax, which at best is only minimally paid, if at all, by multinational corporations, would be harder to avoid and level the playing field for bricks and mortar stores. Finally, making venture capital investments tax deductible, as they once were, would stimulate new company formations, employment, and growth. Any winnings would be subject to capital gains taxes as usual. In taking this approach, lost investments would at least be tax deductible, making the rich less risk-averse when it comes to putting their wealth back into the economy. As Hong Kong proved, reducing taxes paradoxically increases tax revenues. Less is truly more, as Sir John James Cowperthwaite doubtlessly once said. I hope you enjoyed this video. Please feel free to comment below.